Good afternoon. Jamie Breen here. Hope you're doing well. It is April 1st, 2024. Happy April Fool's Day to everyone. I certainly am an April Fool, and I hope you are. Beautiful day here in Atlanta. Easter was yesterday. We had some friends over. We went to church, my annual appearance in church. And then brunch, had a wonderful brunch, a little bit of family and all that. Was my stepdaughter and her husband, and then my wife's cousin and their family. Had a lovely time. Came back, did a little yard work, which I also don't do a lot of yard work, but did some yard work. Preparation for having some folks over. My wife, back before we've been married about 20 years, before we were married, she lived in a neighborhood in North Atlanta, and her across the street neighbor got her involved in playing mahjong. A nicer older couple. Sadly, they passed away a number of years ago, but we've kept this group together. So we had our mahjong group last night, and able to play outside in our backyard, turn the outside lights on, and just had a fantastic time. So very nice holiday, and I hope you did as well. Let's see, this week we'll talk a little bit about the swimming this week. Another good week of swimming. During last week, we 21,000 yards, I think, across 4,700 yard workout on Monday. Was feeling a little crummy, actually. I think I mentioned this. I'd eaten a bunch of candy, which I did again yesterday. I never learn. But I had a bunch of candy on over the weekend, and my blood sugar, I think, was a little messed up. Felt sluggish in the workout, but still, at the end I was okay, and managed to get to 4,700 yards. Did my body 20, my strength training on Tuesday, which was good. Wednesday, did a really solid workout, another 4,500 yards. Actually did a workout that we had done at Dynamo during the winter. It was one where you start with a 200 and then do a 175, 150, 125, 100, and try. It's 10 seconds in between the swims, and you try to hold basically the same pace for all of them, which I was able to do. I was actually a little slower than I was at Dynamo. I think I was 231, 232 in my 200 instead of 230, and everything was about the same amount slower, but water's a bit warmer, and but again, was able to hold that. So we did that once through. It's 900 yards, and then put paddles and a pull buoy on. So did it a second time, and was a little faster with the paddles and pull buoy, as one often is. So anyway, the whole workout wound up being 4,500, so that was good. On Thursday, I did an IM workout. So I was doing, let's see, what did I do? I did 50s of each stroke, 250s of each stroke, and then a 200 IM. The interval for the 200 IM was 230. I wish 330. And the interval for the 50s was I was doing about a minute. So I'd do 250s fly, and then a 200 IM, and then I think I may have swam 100 easy after that, and then 250s backstroke, and then 200 IM. And so you wound up doing 4 200 IMs, and my last one was faster than all of the others, so I was able to descend them a little bit, and so that was good. Friday I did a sprint workout. Did a bunch of 50s after my initial slow warm up, and then I did a bunch of 50s, both swimming and kicking, and then some fast hundreds and some fast 25s. I think the whole workout wound up being 4,400. So that was good. I found a drill for butterfly, and I went in on Saturday and just did some stroke drill. And I found this drill where basically you pinch your shoulder blades together, and you're thinking about just in your fly motion coming kind of across instead of up and over. And that, for me, for whatever reason, it's almost like somebody flipped a switch. And I felt really Saturday when I was doing this drill, and then doing some fly sprinting, and then today again swam some fly, and felt I think I may be onto something here. Probably just recapturing what I used to be able to do. So anyway, so that was good. So again, 21,000 yards for the week. So that's a good week, including the strength training. It's the kind of training that I really want to be doing, really between now and probably late May, and then we'll begin to the process of tapering for the Masters Nationals. So anyway, a good week. Today was a great day. Leanne, our coach, came back to Ansley. She starting April 1st with us after having been with us the last 2 summers. So it was really nice to see her, and did a good workout with her. Sneaky hard, actually. It wasn't a lot of yardage. I only swam about 4,000 today, but it was sneaky hard. Did a bunch of hundreds on 125, descending them. And whenever you're doing that, that's both a tough interval and then your descending effort. It was definitely feeling it today. So things going well on the swimming front. I want to talk a little bit today about, and this is, I'm going to start talking about this relative to fitness and health, but then I'm going to transition, sort of take it a little bit of a different direction, and think about an empirical view of markets, and how certain strategies which probably cut against conventional wisdom might be very, very appropriate for people in my age group, those that are in their 60s and nearing retirement, or even in retirement. And so I'll talk about that a little bit. Again, we're not selling an investment product here. We're just talking philosophy, and maybe having some influence over folks to not buy expensive investment product. Having sold investment product most of my life, a lot of investment product I've seen is not probably worth buying. So I'll just leave it at that. So I think I've mentioned that I've been involved in something called Body 20, which is EMS, electrical muscle stimulation. I think it initially was developed in Europe, and you're basically attaching yourself to electrodes and having low power kind of electrical stimulation to your muscles while you're doing a strength training workout, a short strength training workout, a 20-25 minute strength training workout. And this is from the perspective of how your muscles are being stimulated. You wind up generating the equivalent of like a 2-hour weight training session every time you do this. And I've been doing this once a week now since my first session. I went in for a free intro session in mid-December, and then started in earnest in the new year. So I've been at it for about 3 months now. I did take that week off before the Dynamo swim meet that I competed in, but mostly have been doing this now for a good long while. They actually offer an EMS at my club, but facility is they've got it kind of in a closet, and they're doing a game job. But I think the studio where I'm doing this up in Buckhead at Body 20 is a little bit better from a workout perspective. I think I don't really know, but it seems to be. In any case, they're also, as part of the process, you every week you get on something called an in-body scale, which measures not only your weight, but it measures your body fat and muscle density and a number of things. And it's a really good kind of set of metrics to figure out whether you're making any progress or not. So when I started, I sort of have have some data that they provided me. So when I started on the 19th of December, I was 180.2 pounds, with a body fat mass of 57.2, a little shocking. And I've always considered, I'm a short guy, but I've always been athletic, and the BMI, which was a measure developed in the early 20th century, I don't think is ever, even though it's still in every insurance calculation, it really doesn't have a lot of value, but certainly the body fat mass does. So that's a percent body fat if you also incorporate my water mass, which was at the time 90.2 pounds. So 31.2 almost percent body fat, which is not all that good. My visceral fat level was 11, which you want it to be under 10. So I was a little surprised by these results, given that it wasn't like I was sitting around, eating bonbons last year. I trained pretty hard, and I had good, relative to sort of my history, good times in the both the 5 mile St. Croix Buck Island to Buccaneer swim, and my time in the 5K Big Shoulders swim in Lake Michigan was also actually the best that I've ever had. So I was a little surprised by this. So cut to last week, so 3 months into this, and my body fat mass is down to 47.4, so really down 10 pounds of body fat mass. Interestingly, my cellular water, or intercellular water, extracellular water, my water weight up 95, from 90 to 95, and my lean mass is up. Let's see, from 32 to 35 almost. So basically, the period with which we've been doing good swimming training, but also doing this Body 20, put on about 3 pounds of muscle. The not drinking alcohol during this period, I think, has contributed. I think I must have been sort of systematically dehydrated, put on 5 pounds of water weight, which I think I don't think that that's an aberration. I think that's probably pretty steady given where my weight has been. So 177 pounds, lost 3 pounds, but 10 pounds of fat, and put on 5 pounds of water weight, and 3 or 4 pounds of muscle. So I think the bottom line is, I think that the Body 20 is providing me the sort of results that I would have hoped for, and we'll continue, maybe even ramp up the intensity there a little bit. So it's we're in this golden age where you measurable everything. This the InBody machine is something that's very sophisticated, and to be able to sort of avail yourself of it just at a kind of a strip mall gym studio is pretty amazing. So anyway, that's a bit on that, and sort of the empirical data that suggests that what we're doing is working. I'm actually gonna sort of segue though, as I said. I've been getting a raft of crap in the mail from financial advisors that want me to come and maybe have a steak at Ruth's Chris or something. Nothing against it. I've been the guy on the road sponsoring that lunch in the past, so I'm not casting any aspersions on the morality or validity of marketing in that way. But typically when one is brought in for something like that, you're near retirement, and we've got to teach you how to invest money so that you have success and all that. Often there's an expensive investment product sale that's going on, an annuity or something that's gonna pay the advisor an upfront fee of 3 or 4%. And financial advisors need to be compensated, and good financial advisor is worth every penny that you pay them. But I think that my my skepticism and experience in the space suggests that maybe a different approach might be reasonable. And what I mean by that, if you were to look, and I'm 62 years old, Social Security Administration says that my actuarial life expectation from here is 22 or 23 years. And so, but we do have blessed in my family with some longevity. So let's just think about a 30-year period. And so imagine that we're going to invest money for, take what we've earned during our career, and we're going to invest it over the 30 years of sort of the expected lifespan that I have. The conventional wisdom for this suggests that as you get older, you need to take less risk, right? You need to put your money in bonds instead of in stocks. And I would argue that's really not a very good idea. Sort of over the last 30 years, the S&P 500 has returned 10.8% a year annualized. So every year, you started 30 years ago, 1994. How scary is that 30 years ago is 1994. But if you were to start then and put it in the S&P 500, every year, on average, you would compound it by 10.8%. That's pretty good, right? I mean, that's it's not buying Apple at its IPO, but it's a pretty good rate of return over a very, very long period of time. And so if you were to take that same money and invest it instead of in the S&P 500, if you were to invest it back in 1994 in the Bloomberg Aggregate Bond Index, your annual return from that would have been 4.8%. So 6% more a year by putting it in the S&P 500 relative to putting it in the bond index. So that's a big difference. And if you're trying to spend as much money as you can after you retire without running out, a 6% extra return is going to be pretty helpful. And so, the question that why is it that financial advisors and the financial industry seems to guide people toward this idea of quote unquote less risk when it's just less return? Well, in the minds of those folks, less risk is construed as less short-term volatility of return, which can be measured by variance or standard deviation or a number of different metrics. But basically, is the idea is if something goes down or has the potential to go down a lot in the short term, if you're in retirement, you really can't handle that, and so you shouldn't take that risk on. Here's the thing, though. The worst that it's ever been in the stock market, and we've seen it twice since the 1930s, so really twice in more or less 100 years, is 6 consecutive quarters, a year and a half, where the market, the market was down, the equity stock market was down in every quarter for 6 consecutive quarters. It happened during the Great Depression, and it happened from the fourth quarter of 2007 until the first quarter of 2009, which is fresh in many of our memories, the folks that are in my kind of age group. So, and certainly when that happens, it isn't fun. And if you're invested in stocks, you feel really, really bad when that happens. But here's the thing. What if you figured out how much you were going to spend? So you're at retirement, you've got your money, and you figure out, you budget how much you're going to spend, and you take how much you're going to spend in every quarter for the next 3 years. And you set that money aside and you put it just in cash equivalents. Be real simple. For a lot of time, and since 2000, really since the internet bubble blew up, a lot of that time the return on cash has been very low. But of course, cash is very safe and doesn't ever go down in value. And so you've got it there. The cash return actually now is a little higher, 4 or 5%. So it's actually you earn a little bit on your money, but think of it as a reserve pool. So now and then you take the rest of your money, the money that's not in the reserve pool, and say that's 85%. You're going to spend 5%. Your budgeted spending is 5% a year of the money that you start with, which is that's not overly aggressive, nor is it overly conservative. So you do that, and so now you've got 85% of your money in the equity market, in the stock market, and you've got your 15% of the money in the reserve pool. So a quarter goes by, and you spend the money that you for the first quarter. So now at the end of that quarter, you have 11 quarters of spending, because you spent from 12 to 11. Well, you do that, and you look, and you see that quarter, did the stock market go up or did it not go up? If it went up, you go ahead and sell a little bit of stock and replace what you just spent to replenish your reserve pool. And if the stock market didn't go up, you do nothing. You just let the reserve pool basically take the hit. And so you just do that through time. If you do have a period like that horrible period from 2007 through 2009, 6 quarters in a row, very frightening, you never missed a paycheck, as it were. That is, you had your reserve pool so that your spending budgeted was there for you. But you depleted your reserve pool to 6 quarters, right, from 12 to 6. So in the cases where you've depleted your reserve pool below the 12 quarters, and certainly from that 2007 to 2009 period you would have, when the stock market does finally go up again, what you do is you replace the money that you just spent in that quarter, and then you also replace one extra quarter to build the reserve pool back up. So at the end of the second quarter of 2009, you would have gone from, I believe, 6 quarters to 5. So you replenish right away from 5 to 6, and then you go from 6 to 7 by one extra quarter. And so you just keep running that fairly simple dynamic adjustment of risk and liquidity through time. And if you do that, what you'll find, if you do that through sort of all of the periods, since 1927, what happens is you run out of money doing this less often than any other asset allocation strategy that you might think of. And you have a higher average legacy, or what you leave to your children, charity, whoever, than any other strategy that you could think of as well. So what we're doing is, instead of thinking about risk in asset allocation as short-term volatility, which is pretty easy to solve for with a reserve pool, we're thinking about risk as the chance of running out of money, which is a much more tangible and important risk metric for people that are in retirement than the short-term up and down, which is very easily corrected with a dynamic adjustment reserve pool and risk taking. Now, used a lot of big words: standard deviation, risk, liquidity. But the fact of the matter is, this is a strategy that, with a little bit of thinking, you can do on your own very easily. Don't need to hire a financial advisor, don't need to buy an annuity, don't need to do anything. And you're actually utilizing some fairly sophisticated decision theory and risk management by doing it, but it isn't rocket science. It's just solving the problem at hand. So anyway, the reason that I thought that today would be April Fool's Day, being an April Fool, I thought today would be a really good day to talk about this, because we've just finished a quarter where the S&P 500 up 10 point something percent, so a very good quarter. And so this would be a time when you take a little bit of what you earned and you put it into your reserve pool. And so again, it's this adjustment of risk and liquidity, and not hard to do on your own. So that is my lesson on money today. Thinking about empirical data, this sort of, if you test this over lots and lots of periods, pretty sound, works well. Apparently going to the gym works well also. Got some empirical validation of that, so that's good. So anyway, have a wonderful week, everyone. And please, if you have the chance, click on the subscribe button. And I'd really appreciate that. And I'm not quite sure where we're going with this YouTube. I'm trying to build subscriber thing, whether I'm serious about this or not. But if you think this content is good, please do subscribe, tell your friends, neighbors, all that sort of thing about it. Anyway, have a great week. Thank you again.